The Federal Reserve has decided to keep interest rates on hold, marking the first policy decision under new chair Kevin Warsh. Joining us now for more is Hafiz Noordin of TD Asset Management. And Hafiz, this was Kevin Warsh's first Fed meeting. Here's the Fed statement. It's noticeably leaner than we're used to. You've had a chance to digest it. Did anything jump out at you? And more importantly, did the tone or messaging feel like a break from the Powell era?
Right, there were a number of shifts, I would say, from the last meeting. And it wasn't just from the new Fed chair, Kevin Warsh, but even the committee more broadly signaled a little bit more hawkishness. And so let me start with the committee itself, because we got a new dot plot, right? So the dot plot, what the market consensus was kind of expecting going into this was that about 2 or 3 dots would signal a hike by the Federal Reserve this year. What we actually got was out of the 18 dots, 9 of them signaled a hike. So there was a clear shift towards expecting hikes. So that easing bias is clearly gone from the committee in general. But then bringing it back to Kevin Warsh, he did not submit a dot. So he definitely, and in the press conference also said that he doesn't really, that's not a tool he sort of believes in, that it's not sort of something that he thinks is helpful. But he didn't sort of push back on the rest of the committee, submitting their own dots. So I think that's going to be interesting to see how that evolves. But I think the other key pieces of the communication today, you noted the statement, very brief, very to the point, just the facts. But the last piece we got was a number of economic projections. And so when I look at all of that, we do see that the Federal Reserve committee members are expecting, they're forecasting higher inflation, lower unemployment. And so all of that, when we put it together, is that the easing bias has been, very clearly removed from their communication.
Now, another thing that Warsh has talked about is creating several task forces. What's your takeaway from this?
Yeah, so that was definitely a new sort of take on how the new Fed chair would be rethinking how the Federal Reserve operates. It covered some key areas, communication, balance sheet. How they think about productivity and jobs. So there's a number of areas. What was definitely a clear message, though, in the press conference when asked about those task forces is, around the inflation target. Reassessing the 2% inflation target is not on the table, right? So I think that was a very clear message. But what I would say is kind of the sort of the other side of that coin, in my view, is that anything outside of that is on the table. And so I think that's a clear, sort of leadership style that, he's willing to reassess, a lot of the ways that the Federal Reserve operates, not only how it communicates, which we saw some of that today, being more brief, not, de-emphasizing the dots, but perhaps this point around balance sheet, could come into question. It didn't, there has been talks of the balance sheet and, reducing that. He didn't indicate anything today that there's, any plans around that, but a task force around that could mean, that there's more to debate around that.
So something we'll have to keep an eye on going forward.
Yeah.
I want to kind of touch on geopolitical risk, because obviously we've got a tentative deal to end hostilities between the U.S. and Iran. Oil prices are pulling back. What does that do for the inflation picture, and how might that impact monetary policy going forward?
So we did see oil definitely coming down quite a bit. But at, so let's say WTI at about $75 today or so, that's still, about 30% higher, I think, from January 1st. So oil prices still are feeding into higher gas prices. And then when you measure inflation using a headline CPI, higher oil and gas is feeding into that and leading to higher inflation. But we know that the Federal Reserve already kind of strips that out, right? They look at core PCE, which excludes food and energy. The challenge there for the Federal Reserve is that even core PCE has been increasing. It started the year at 3%, it's now at 3.3%, and the next print is forecasted to be 3.4%. So that trend is troubling for the Fed, and I think that's kind of why we saw this, caution by the dot plot, or indicated in the dot plot that the bias may need to be that there'll need to be hikes. So I think it'll come back to how does core inflation particularly progress from here, and that's going to be I think the key dilemma for the Fed.
And what does this all mean for Treasury yields from here? I mean, do you think there's room for yields to perhaps move lower, or has some of that good news already been priced into the market?
I definitely the good news from the oil price has sort of fed in. We saw higher equity prices, we saw oil prices come down, and we did see a modest decline in bond yields. But it didn't go back to beginning of the year levels. And I think part of that is that, again, oil is still meaningfully high from where it was. But I think underneath that is also this recognition by the market that core inflation outside of oil and gas effects is still elevated, right? And being fueled more by strong economic growth in the US, by low unemployment, demand is very strong. So there's other inflation pressures that are still showing up. And so that's why we can't see bond yields coming down more meaningfully. But if you look at today's move, it is also interesting in that if we do see Fed hikes being repriced in, the big move today was in the 2-year bond yields, up 10 basis points or so after that hawkish dot plot. But the 10-year US bond yield didn't move a lot. It's only up 1 or 2 basis points. So it's actually kind of in a stable range of 4 to 4.5 right now. It's not where it was closer to 4% at the beginning of the year, but it's stuck around 4 to 4.5. And I would say that means that it's higher yields for longer. But that's not necessarily a bad thing. It just means you're structurally getting more income as a fixed income investor. And we have to see how the economic data evolves here to see if we'll get a big shift away from that kind of 4.5 on the US 10-year.
Okay, so given that outlook on interest rates and higher yields for longer, how does this impact, how should investors be thinking about the US dollar in this environment?
So the U.S. dollar has been an interesting kind of sort of trend this year in that it really depends on what you look at versus the U.S. dollar, right? So there's kind of 2 key ways. I'd say the U.S. dollar versus a global basket of currencies, the other large currencies like the euro and yen. When you compare the U.S. dollar to those major currencies, it's only up about 2% this year. So it's been kind of stable because you've also had the ECB hiking, you've had the Bank of Japan hiking. So you're getting higher interest rates globally as well. So when you have interest rates moving in tandem across countries, you don't necessarily get a lot of big currency shifts. But versus the Canadian dollar, it's been a different story. The US dollar's appreciated about 4 to 4.5% maybe after today relative to the Canadian dollar. And I think that's reflected the idea that US economic growth has been surprising to the upside and Canadian data has been surprising to the downside. And that's shown up in the currency. There's probably a bit of a discount there for the CUSMA negotiations and the risks to trade, and how that could be more of a downside risk to Canada. So I think from here on, the U.S. dollar, there's maybe a bit of upward pressure given what we saw today from a hawkish Fed versus Canada, though a lot has been priced in. But I think there's still of that, that insurance role that the U.S. dollar could play if trade sort of issues come up again.
So, given all these things that we've been talking about, this potential deal with the U.S. and Iran, we've got inflation still an issue. What's the one thing that you'll be watching closely as the Fed considers its next move?
Well, I think those task forces will be really, really important, right? Because there's, outside of the inflation target of 2% as being sort of sacred. Everything else, there's a lot of leeway, I think, for how the Fed could change its role, right? So I think, we pointed to the balance sheet. I think that'll be a critical thing to watch. But I think outside of that, the bigger picture I would see, and probably the most important in the near term, will be that, with less communication from the Fed, it's more on the markets, it's more of the market's job now to digest data and not wait for the Fed to tell them. And I think the inflation data will be the key thing to watch going forward on whether we do expect to see hikes coming into fruition from the U.S.